Hello, dear viewers. Are you ready to embark on a profitable journey today as we unveil one of the magical secrets of the financial world? As you may know, financial markets are constantly changing, and a significant portion of these changes occurs simultaneously with the opening and closing hours of the London Stock Exchange. That's where the volume analysis indicator and synchronized charts with the London Stock Exchange, which we are about to introduce to you today, form the foundation of a strategy commonly used by professional traders and investors. This strategy will help you uncover the secrets of profitable trading and take your first step towards financial success. Let's open the doors to this magical world and welcome you to our educational journey where we await to teach you this strategy that will lead you to financial success. Now, without further ado, let's begin learning our volume analysis and London Stock Exchange strategy. After optimizing the settings of the two indicators, let's dive right into learning the trading rules. On the chart, you can see a red box indicating the London session. The upper and lower levels of this box will be the most valuable levels for us, forming the foundation of our trades. Therefore, after the box formation is completed, we draw a horizontal line above and below the box and wait to see in which direction the price will move. We notice that the price has crossed below the lower level of the London session box, but the volume analysis indicator did not give a red-colored ultra-high volume confirmation the first time it crossed downwards. Therefore, we wait, and after a few candlesticks, we see a strong red candlestick confirmed by the red column of the volume analysis indicator. This confirms the conditions for a short position. It would be logical to set the initial target level at 1 to 1.5. As you can see, while the trade is open, a different London session box has formed. In this case, if the newly formed session box moves in the opposite direction, the trade should be closed immediately. We will see an example of this shortly. Please watch the video without skipping to improve your experience with the strategy. The last session box that formed during the trade on the screen did not disrupt our trend direction, so we reached our target. Now, I want to show you an example you should pay close attention to. The lower level of the London session box is breaking downwards, but I don't see a high volume column in the volume analysis indicator. Consequently, opening a short position here would not be a wise choice. Later on, the price makes a retracement move, and we see a red column in the volume analysis indicator. The red candlestick that coincides with this red column is called a pin bar. Despite its red color, this candlestick has a longer wick below the body. The long wick at the bottom of this pin bar still indicates the presence of buyers in the market, making it a bullish candlestick, and therefore, a short position should not be entered. As you can see, refraining from entering a short position was a very wise choice because the pressure from buyers in the market increased, and the trend completely reversed. If we had not seen the risk and entered the trade, our trade would have closed at the stop-loss point. You can go ahead and subscribe, hit the like button, drop even a small emoji in the comments section, and share the video if you'd like. Thank you. Let's continue. Let's look at a different example here. We can see upward market pressure pushing above the London session box. The first candlesticks that broke above the session box were not confirmed by the volume analysis indicator, but the candlestick marked on the screen was confirmed by the indicator. Please take a close look at this candlestick. It has nearly equal length wicks at the top and bottom, and its body size is close to the length of the wicks. In short, if we were to divide this candlestick into 3 equal parts, each part could be considered of roughly equal size. While it may not be an extremely strong signal, the setup aligns with the strategy rules. Therefore, a long position can be initiated. Of course, traders who find the formation weak may choose not to enter the trade. Traders who prefer a more cautious entry can consider entering based on the clear bullish engulfing candlestick formation you see here. Of course, you may wonder if the volume analysis indicator confirms this candlestick. You're right. A clear bullish engulfing candlestick formation has formed, but the indicator did not confirm it. Nevertheless, the breakout of the session box to the upside, a proper retracement, and finally, the formation of a clear bullish engulfing candle suggest a low risk, high reward potential. You can enter the trade from the closing level of the last green candlestick, and two different stop-loss levels can be used. And the trade is still open, but we've spotted a new London session box. Moreover, the box broke to the downside, and the seller group made its presence felt in the market. In this case, we must definitely close the trade. We made a small profit, but we still added to our capital. Keeping the trade open against such a formation would have been an amateurish move. Let's look at a different example here. As you can see, the London session box was breached to the upside, and we can say a bullish trend has started. However, because we prefer the safest entry, we want the volume analysis indicator to show a red-colored column. So, can't we take the trade when we see a yellow-colored column? A yellow-colored column also indicates that there is high volume. Of course, it's not as strong as the red-colored ultra-high volume column, but traders willing to take this risk can consider it as an entry option. For now, we are waiting for the red-colored column confirmation, as it is the safer option. Here, we see a red-colored ultra-high volume column accompanying a very clear bullish engulfing candlestick formation. We have a flawless setup for our strategy. If we briefly analyze the trade outcome, traders who entered the trade when they saw the yellow-colored column have also reached their targets. So, what do? We immediately hit the like button. I will show another example, and in this example, I will try to teach how different stop-loss alternatives can be used. Please watch carefully because, as you know, no matter which strategy you use, the stop-loss level serves as a safeguard for the money in our pocket. And again, the session box broke to the downside, accompanied by a yellow-colored high-volume column in the volume analysis indicator. This can be used as a preference, but traders waiting for the red column patiently waited until they saw the formation that met their conditions. Even though it was a bit late, the conditions were met for a short position. As you can see on the screen, there are 3 different stop-loss levels. Why are these options 3 in number, and do multiple stop-loss levels occur in every trade? Of course not. In this example, for aggressive traders using the breakout accompanied by the yellow column in the volume analysis indicator, the stop-loss levels marked with numbers 2 and 3 can be used. Stop-loss level number 2 is close, while stop-loss level number 3, although distant, is a level used in the style of professionals. For cautious traders who prefer a conservative approach and enter with the red column in the volume analysis indicator, they have the opportunity to evaluate all 3 alternatives within their own risk management framework. And here, we can see that the downtrend continues. Investors who correctly set the trading rules and risk management always come out profitable. Those who experience significant losses are typically individuals who disregard risk management in market actions, act impatiently, and are driven by the desire to win. Wishing you plenty of profitable trades. Goodbye.